June CPI report was just barely released this morning, and oh my lord, guys, we have some serious problems that we need to talk about. This report was so dang bad that it's going to be changing up possibly what the Fed might be doing here at the next interest rate decision. So make sure you stick around to the end of the video and we'll talk about exactly what is happening and exactly how this could impact the stock market. So for those of you that don't already know what CPI is, it is called the Consumer Price Index, and all you really need to know is that it's just a way that we measure inflation here in the States. Now, whenever CPI is released, there are technically two different sets of CPI numbers that we get. We get what is the headline CPI number, and then we also get what is called core numbers. Now, the headline CPI number, that is an all-encompassing measurement of inflation. It includes literally anything that you spend money on is in there, from your rent to your gas to your groceries to anything, okay? Now, the core number, what that is they strip out food and energy. So basically your groceries and your gasoline. And the reason why that is because typically food and energy are a global commodity. So it's on a global scale, not just a national scale here. And so typically our monetary policy does very little to impact those two items. So the Fed likes to look at the core numbers so that way they can get a good idea of what their monetary policy is actually doing to items that it can affect on the CPI report. So now that everybody is up to speed on what CPI and core CPI are, let's talk about the numbers and actually how they came in on this report this morning and why this is going to be a potential problem for the stock market. So as you can see right here on screen, you can see that we have two different sets of numbers. We have our forecast and we have our actual number that came out in the report today. Now, the reason why this forecast number matters so much is because with these forecast numbers, these are generally what the stock market is pricing in. So anytime that we get a higher read than these forecast numbers, generally it's not good for the market. So here we are, we're looking at the headline number of CPI right here on the year over year figure. And as you can see, the forecast was 8.8%, and this morning, this came in at a 9.1. So pretty nasty already just looking at our headline year over year number. Okay, well, what about our month over month number? Well, we forecast a 1.1% headline month over month CPI number, and it came in at a 1.3. This is literally now the largest month over month move in inflation that we've had all freaking year, guys. This is not good. Okay, so maybe the core numbers came in better. I mean, we just barely talked about how that's what the Fed actually looks at, right? So maybe those came in a little bit better. Well, let's go ahead and jump over here onto the year over year. We forecast 5.7 and we got 5.9. So ladies and gentlemen, that is another beat above the forecast number, even here on the core. And then if we come over here and we look at the month over month on core, well, again, a bit of an oopsies. Forecast for a 0.6 increase and we got the 0.7. And in my opinion, guys, this core month over month, this is really the worst bit of the data that we got today. And the reason why is because we had been sitting there at about a 0.6 month over month increase, and it had been holding steady. And so when we had forecasted to just come in and stay neutral, obviously that's not the best, but it at least gave us some hope that, hey, maybe it's going to stay down and at least just stay flat. But instead, no, even on core, which remember, this does not include your food. This does not include your gasoline. It still rose at 0.7. That is terrible. We are starting to move back up, and this is going to put significant pressure on the Federal Reserve to start to raise interest rates faster. And I'm going to show you exactly what I mean by that. So if we hop over here to the Fed Rate Monitor tool that's on investing.com, we can see that now after today's CPI report, take a look at this. We are now expecting the Fed to jump us a full point, guys, in July. We are now expecting that on the 27th of this month, we're not going to get the 75 basis point hike. We're going to get the full point hike. And if you want to know just how much of a shocker this report really was, just look down here at previous day probability. You can see that as of yesterday, the market had only priced in a 10% probability that we are going to be getting a full point hike. But now, after this report is out, we're sitting at 57.7%. So literally over half the market has now decided that it is probable that we're going to get a full basis point hike. And this is exactly what I had talked about in my video yesterday that I had posted, to where I said that if these month over month figures on core came in hot, it was very probable that we could see the Fed come out and say, hey, we've got to move faster and we've got to do the full point hike in July. So if you are wondering why stocks were in the toilet this morning, even in the pre-market, it is because of this release and because now the market is literally swaying that we could get the full point hike here in July, which would speed up our rate of tightening policy immensely. And now that over half the market is expecting this full point hike, it's more probable that the Fed is actually going to go with it. I mean, even in their last FOMC minutes that we had read, then they had talked about how the credibility of the Fed was something that they wanted to maintain. Well, part of how you maintain that credibility over at the Fed is by going with what the markets are already pricing in. So if the market is already pricing in a full point hike, it is kind of in the Fed's court to now say, all right, we're going to go with the full point hike because that's what the market thinks we should be doing. So with all this being said, what we should actually take away from all this is that between now and July 27th, which is 2 weeks away still, which is when the federal interest rate decision is, it's very likely that stocks are going to continue to be volatile and possibly continue on a downward trend. Anyway, guys, if you did find some value in today's content, please do me the favor of hitting that subscribe button down below if you aren't already subscribed, as well as the like button, as it will help this video find even more people. Until next time, peace.